Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly podcast show brought to you by the Consumer Financial Services Group at the Ballard Spahr Law Firm. And I'm your host, Alan Kaplinsky, the former practice group leader for 25 years and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I'm pleased to be moderating today's program. For those of you who want even more information, don't forget our blog, which also goes by the same name as our podcast show, that is Consumer Finance Monitor. We've hosted our blog since 2011, on the very same date that the CFPB became operational. So there's a lot of relevant industry content there. We also regularly host webinars on subjects of interest to those in the industry. Last year, we did about 20 webinars. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, let us know about it. You can leave us a review on whatever platform you may use to access your podcasts. And also, please let us know if you have any ideas for other topics that we should consider covering or speakers that we should consider as guests for our show.
So let me describe to you in a little bit of detail, more than usual, what we're going to be covering today so that I can provide the appropriate introduction to our very special guests today. And then we'll have a discussion which will bring to light some really major changes that are going on. We're going to be talking about bank and non-bank supervision and examination by the Consumer Financial Protection Bureau, CFPB. And then we're also going to be talking about what's going on at the bank prudential agencies with respect to supervision and examination. And of course, I'm referring to the OCC, the FDIC, and the Federal Reserve Board. So the idea for doing this podcast show today emanated from widespread reports that the CFPB may dramatically scale back its supervisory and examination program, potentially moving to fully virtual examinations, sharply reducing the number of supervised entities that would be examined each year from roughly 600 per year, get this, 600 to closer to 70 per year, narrowing the scope of examinations, and, get this one, requiring examiners to take what has been described as the, quote, humility pledge, unquote. I guess that's like pledging allegiance to the flag or something like that. If accurate, and I believe these rumors are accurate, I have confirmed them with several sources within and outside the CFPB, these developments would represent a fundamental change in the Bureau's supervisory posture and philosophy. And they raised very important questions, particularly for those of you who are listening today who are subject to CFPB supervision and examination. Questions like, what will supervision look like? What risks remain for banks and non-banks? Will enforcement continue to play any role at all? We all know that it's really been over a year since the CFPB has really done any significant and meaningful enforcement. They settled all the outstanding cases, but practically all of them, with a couple of exceptions, of all the cases that were still pending when Rohit Chopra resigned and when acting director Russell Vogt replaced him. And how are the federal banking agencies going to adjust their own examination practices? A significant theme across agencies has been the de-emphasis of so-called reputation risk, a category previously used in examinations to assess how banks manage risks tied to customer relationships, business lines, and emerging products. In 2025, UOCC publicly announced it would no longer examine for reputation risks, and it pivoted examinations toward more transparent financial risk areas. And both it and the FDIC subsequently have proposed rulemakings to exclude reputation risk from supervisory programs entirely. The Federal Reserve has indicated similar intentions, seeking to formally remove reputation risk from its supervisory materials and replace it with clearly defined financial, operational, and compliance risk frameworks. Another notable shift has been rebalancing the intensity and frequency of examinations. Under current leadership, the OCC has signaled an intent to suspend mandatory examination activities not statutorily required for community banks. And regulators more broadly are using more targeted, risk-based examination plans with much clearer scopes defined at the outset, which is in stark contrast to a broader process-oriented, check-the-box kind of examinations that have been done in prior years. There have also been proposals to adjust the scope of continuous monitoring programs for the largest institutions, potentially raising thresholds for frequent review. Interagency efforts have likewise focused on regulatory clarity and procedural reforms in supervisory processes, including proposals for uniform definitions of unsafe and unsound practices and updates, this is very recent, to the appeals frameworks within the OCC and the FDIC to make it much easier and with a much higher likelihood of success if banks want to challenge supervisory determinations. This reflects an ongoing push toward greater transparency and predictability in examinations under Trump 2.0. Finally, these changes are happening against a broader deregulatory background through executive actions and deregulatory orders that require heightened White House review of agency rulemaking. The administration has signaled a priority of reducing perceived regulatory burden across federal financial supervision. This is what I would call an architectural shift that implicitly shapes how examinations are designed and conducted by all three primary banking regulators. So I know this was a rather lengthy description of our topic. We're now really going to take a much deeper dive into the specifics of what we think are going on and what they mean for your individual institution. And I don't think I could have found anyone better qualified to talk about this subject than my very special guest, Sherra Brown. Sherra is the head of regulatory research and analysis for the Americas at Vixio Regulatory Intelligence, where she leads analysis of regulatory change affecting banks, fintechs, and payment firms. She brings aboard 20 years of regulatory compliance and supervisory experience, including her service in both compliance policy and examination as a bank examiner at the Office of the Comptroller of the Currency. She has also advised large financial institutions on CFPB examination readiness at KPMG and served as a compliance testing manager at Navy Federal Credit Union. She is recognized as a leading thought leader on supervisory and examination trends, compliance management systems, and regulatory change. Sherra, a very warm welcome to you.
Thank you so much, Alan, for having me today. And that was a great welcome.
Okay, well, there's been, Sherra, is, a lot of speculation and a lot of media attention being given to the dramatic changes in the CFPB supervision program. Let's start with that, what I would call a big picture level or at a high level. What are you hearing about the direction of CFPB supervision? Are we really looking at a major structural reset of the supervisory model? And I would say, before you answer that question, at least to my knowledge, during 2025, the CFPB didn't conduct any examinations, either in person or virtual. They did nothing. People were told not to do any work, instructed not to do any work. So, wondering if you could tell us what you know or what you've heard.
Yeah, so essentially, Alan, what I have heard, I'll start with saying I don't think it's any surprise to anyone that, the CFPB being on a chopping block, in this administration, that's no surprise to anybody. And so, in terms of the memo that recently came out, just kind of alluding to what the supervisory expectations are going to be coming up, that they are ramping up in April. It will be 100% virtual. In terms of the areas that they're looking at are a big contrast to what we're used to seeing from the CFPB. And so it makes one actually ask the question, is the CFPB really doing this as just kind of a view to actually appear to be doing something, or is this just the direction they're actually going in? And I think that part kind of remains to be seen on that. But on paper, it looks like they're taking a risk-based approach. The risk-based approach to examination, that's nothing new. Regulator has taken that approach at some point in time. So that part does not seem to be anything that you would say would be unusual on paper. However, when you actually break it down and start looking at it, it does start to make you wonder, are they actually back up and ramped up in doing? Because to your point, last year they didn't have any exams. They were told to, stop doing examination in addition to the, reduction in staff that they've had over the past year. The question of, are there going to be more reduction in staff this year to even align up with, them saying they're going from 600 exams to 70 exams? It just kind of remains to be seen. But in terms of what they're saying is, not too much different from what they initially said last. I think it was April. They came out with something saying that the focus was going to be service members, ensuring that they're actually, looking at things that are critical to consumers, not necessarily going into just the check the box phase from them, removing the disparate impact. That's something that's not going to be looked at going forward into the new year. But then in terms of just the virtual aspect, I think we have seen the virtual aspect, during the pandemic where examiners were doing, 100% virtual. How's that going to differ from, what they're currently doing right now? I don't see a huge difference because they've already done it. In terms of what banks should expect, they've already had that part. I don't think it's gonna be.
Can you, I'm wondering, for our listeners, because some of them may never have actually been through a virtual exam, how exactly does that work? Procedurally, do they first make a document request to the institution and documents are provided electronically? And then what do they do? And how much different is it from an in-person exam?
I think the whole the biggest thing that's gonna be the difference from an in-person versus a virtual exam is just the relationship building. It's really hard, as we've all kinda seen, to well, I'll say this. we've all gone through the pandemic. We've all gone through, using, WebEx, Zoom, whatever your choice of, virtualness is to build relationships. But I don't think it's just still the same effect that you have when you have somebody in person. You're able to actually, do a lot more in person meetings, have a lot more conversations that you just, are kind of limited to when you have an hour meeting, a 30-minute on the block versus if you're able to actually, reach out to talk to your examiner in charge that's there, just to frequently, I think, just build that relationship. That's I think the key part of what's different about a virtual exam in terms of, how the process actually works. No different to any other exam. You're going to get your request letter where the, agency has pretty much identified what they want to see before coming in. I think, if you have not already gone through a virtual exam before, the key things that you should be making sure that you actually have in place is readily available files. Your data is going to be really important. Your data is always important, but I think just in this case, it's even more important because it's the virtual aspect of it. Oftentimes, sometimes in exams, you're able to provide them with, the documents, on site versus it being through the virtual aspect of it. So just ensuring, that, you have your documents readily available, that, you've actually gone through and that, the data integrity there with those documents are in place because being in a virtual setting, like I said, back to that relationship building, it's a little bit harder to kind of have those conversations when it's a virtual aspect. But honestly, if I think about even at the OCC, when they went from in the pandemic to 100% virtual and not being on site, a lot of documents were already being presented and provided electronically before the pandemic happened. And so a lot of institutions should already kind of be at a point where they're, able to electronically provide documents to go through these exams. But I just think it's going to be the process of not actually having an examiner in charge to really build that relationship.
Yeah. So are you saying that in terms of the breadth of the review or the examination, they're at least theoretically, at least during COVID, they looked at the same things, except they did it virtually rather than present in person. Do you think under this new protocol that may go into effect as early as April 1, it's going to look like that? Or do you think because they won't have as many staff as they had before, and we really don't know what staff they're going to have. We know from the litigation that got filed by the unions against the CFPB that during the early part of that litigation, there was a hearing where the CFPB came up with a figure of the number of people it felt it needed in the supervision area. And it was a big, big reduction from the number that it had under the prior administration. Do you think that they're going to cut back significantly on, what they're going to look at, the areas they're going to focus on, and do you think as a result of that, examinations are going to be a lot shorter than what they have been?
It's gonna be, I think, more of a reduced examination, not necessarily because of the virtual part of it, but, a few things that you said, which is the reduction in staff. Granted, they're going from 600 to 70 exams, but still 70 exams in a year with a reduced staff is still, how much can you really do in that time frame to do that? But then also, if you look at the document that came out of just kind of what their focus was gonna be, one of the things is they are gonna be relying, heavily on second line testing from those institutions. They're also gonna be, steering clear of areas where the states have already looked at some of those areas. And so I think that kind of flows into a more of a narrow view of what they're actually gonna be looking at. And then it goes back to really the point of where's the agency going? Is this just for show or is this actually really the way that they're actually going to be building their model to do more of a reduce more of a narrow focus that's more risk based? Or is this just they're just doing the bare minimum that they need to do to stay in line with what's going on the litigation side and their desire to want to close the CFPB. So I think that also kind of folds into where the scope is going to be on what's there, remains to be seen. But I think a key point to bring into this is that while the CFPB may be changing what they're looking at and what that examination process looks at, that does not stop what the states can look at and what can be subject from a look back perspective. So, in terms of how do you prepare and, the question of, well, how am I preparing for this? What am I looking for? I think what you're doing currently right now, that if you're doing what you're supposed to be doing correctly in terms of compliance and compliance risk, that shouldn't change. And I wouldn't let the examination of the CFPB sway what you're doing and how you're maintaining your documents and how you're doing compliance, because ultimately you can be subject to other, entities, looking at you for compliance.
Yeah. We don't know, I guess right now, whether the CFPB intends to do joint examinations with state banking departments. I guess during COVID, it did that, didn't it? Or am I mistaken? I thought that they did. And also when they did in-person exams, weren't they often collaborating with state banking departments?
Yeah, they often collaborate with state banking departments, and either the state will let them know when something is being examined or is potentially doing it, or vice versa, just for avoid duplication of efforts. However, I haven't heard anything where the CFB's reached out to any states.
I would I would doubt whether they'll be working together. I hope I'm wrong. I mean, I think it does make a lot of sense from an efficiency standpoint and to have the agencies working together, but I don't think there's a lot of cooperation these days between the state banking departments and the CFPB. Another question, and I don't know if we know the answer to it, but the 70 entities that they plan on examining, who are they going to examine? We know they've got the right to examine the largest banks in the country and credit unions, those having 10 billion or more in assets. They don't have the right to examine banks and depository institutions whose assets are less than that number. They remained subject to examination by the comptroller, the FDIC, the Fed, the NCUA. Early on in that same litigation that I mentioned a short while ago, where the unions had sued the CFPB over their belief that the CFPB was going to try to shut down the agency, they indicated in some document that got submitted to the court that they were going to focus on the banks, as I recall, and not the non-banks that they have a right to examine. They got the right under Dodd-Frank to examine number of non-banks, payday lenders, including is one category, mortgage servicers is another, and then they've enacted a lot of larger participant rules, which give an even broader authority to examine other sub-industries within consumer finance. And I think what they said, Sherra, was the reason, and this goes back about a year ago, so they may have changed their mind. But I think what they said is that the non-banks are already being examined by the states. And of course, very often the banks are being examined by the states, except for the national banks and the federal credit unions and the federal savings and loans. So it looked at least a year ago like the focus was going to be on the large banks. I'm wondering if that's still the focus, whether what they intend to do is 70 or so virtual exams of the, the largest banks in the country. What have you heard?
So I am hearing essentially, in the document that came out about just talking about, exams, they weren't specific on who they were going to be examining. But if I were to bet, it's going to be the large banks that they focus on. I actually heard the question of, in terms of just how it plays into the debanking conversation, if that will be kind of a determination of the banks that they end up looking at, which debanking, that part of it should not have anything to do with the CFPB. But the question is will that be some of the entities that they end up looking at? There's nothing really that's kind of leads us to where we would know who they're going to be examining. But I definitely will say that the non-banks won't be on there. I don't think, from what I've seen that they're gonna be looking at non-banks. And if I remember correctly, last year, remember when they went back, they didn't actually do they didn't rescind the rule. I think it was around May or April, that rule, that
The risk-based, where even if you weren't enumerated in Dodd-Frank, and if you're not part of a larger participant rule, they've got the right to basically designate
yeah.
somebody, a company, a non-bank, as being a threat to consumers, and to subject that company to regulation. I think they repealed that.
Yeah, they didn't what they ended up doing, they didn't the way that they pulled that back was it wasn't through a repeal or rescission. I forgot there's a special process that they were able to do. So essentially by them using that process and kind of circumventing through that process, you can't go back and put that rule back on the books unless you drastically change that rule in there. And so to me, that just kind of signals in terms of just when you think about, the banks versus non-banks and just where their direction is, that, that space I think is not going to be a space they're going to be focusing on out of that 70. It's definitely going to be banks that they focus on. And then when you look at to even them just looking, from credit bureau standpoint, I just don't think, it's going to be a bank focus is where they're going to be more towards.
Well, you raised a good point. You mentioned the D word, debanking. And that, of course, is, I guess, like tariffs. That's one of President Trump's favorite words. He loves tariffs, and he loves criticizing, particularly large banks, for debanking. And in fact, he brought a lawsuit. We won't mention the names of any banks. Most people have probably read about it, against a major bank, claiming that he and his family had been debanked. And I'm wondering whether that's going to be part of the examination protocol, whether they're going to be looking into that area where it's questionable whether they have authority or jurisdiction to look at that area. But I think that's sort of an academic question, because they'll do whatever President Trump tells them to do.
That part is true. That's why I kind of lean towards the banks that potentially may be the ones that get examined that are under that authority that, kind of were on the list with the banking to go into that space just based off of kind of, I think what we've seen over the past year, that is, technically something that is a viable, thing that it could actually happen. But in terms of just the debanking part of it and that being a part of the CFPB, what they're examining, looking for, each agency, aside from the CFPB, the prudential regulators were responsible for going through their portfolio and, asking those questions about debanking. So I know that OCC did that process and they issued that report that came out about debanking. So from what I gather from that, I don't think it should be a part of this, examination because your prudential regulators should have already, assessed you against whether or not, there were any, issues with the banking. And so that will be something I think that, those regulators will be looking at versus the CFPB. But uh, from what we've seen in the past year, nothing's off the table.
Now, and I think I have this vague recollection that acting director Russell Vought at some point during the last year, said something about looking into debanking. I don't remember now where he said it or why he said it, but it came up at some point. And I think he'd certainly welcome opportunity. In fact, he probably would make the entire examination about debanking if he felt he could get away with that.
Yeah, I would agree with you on that. Granted, though, like I said, what we've seen this past year, anything's possible.
Yeah. So let's talk about this humility pledge, which I've never heard of anything like it. Have you? That they've, at the outset of each examination, there is an actual pledge that's got to be recited by, I guess, the examiner in charge. I guess it can be done virtually, or, and I don't remember, I don't have the wording of the pledge, but what's your take on that? Is that symbolic, cultural, operational? And what effect is that going to have? Does that mean that the company, the examinees, the companies being examined are really in charge of the regulators. It's like, you know, the fox being in charge of the chicken coop. I mean, what is it? Is it window dressing? What is it?
To me, Alan, it's just I think it's window dressing, quite honestly. I can't think even as a compliance officer of, what would a compliance officer, do with the pledge that you'd be giving, other than I think when it comes to truly, if it is a case of, you know, you have a examiner that's being very egregious on what they're doing or something like that, where you would really kind of, I think, maybe push lean into this. But I mean, I don't really see the benefit of it. I've never, seen or heard of examiners having to do a pledge. And even like just looking at just, you're pledging to, reduce the time of the exam and to stay within budget. There's just a lot of window dressing. I don't think, anything other than it's just something that, I think to cause the examiner to, I think maybe the way the examiner feels having to read that, they haven't been really specific on, how that's gonna be done, whether it's at the beginning of the exam and you start your exam off, but even just how I guess it'd be in your initial kickoff meeting with the team at the bank as an examiner in charge that you would, read or recite this, pledge. Yeah, it's just interesting to me that this is something that's even a thing and that they're actually having to do.
Right. So to summarize up to this point, then we're going to turn to the bank prudential regulators and what they have been doing so far and what direction they're moving in. If you're a CFPB entity subject to supervision, what you really want to look at, I mean, they're not going to look at everything. But let's put aside deep banking because I have no idea whether to look at that. We know they're going to look at loans to the military. There's no question about that, right? There's not, I don't think, another area that they are more interested in, and that is to make sure that the military members or their families are being treated fairly. And then there is the Military Lending Act, which is one of the main statutes that companies have to comply with, both in terms of interest rates that are charged and certain things that banks can and non-banks can do and can't do. There were other things mentioned in the submission that was made to the court last year. And on our blog, I know we wrote about that. And there were other areas that I identified. I can't remember right now specifically. We know they're not going to look at fair lending unless there's some obvious, very obvious form of discrimination, disparate impact. We know they have no interest in anymore. And I don't think they're going to be very focused on technical violations of truth in lending, the Fair Credit Reporting Act, and things like that. Anything further you want to add on that?
No, I would agree with you. I definitely, military, anything to do with service members are going to be, areas they focus on. But then when you even look at the Fair Credit Reporting Act, there have been things in the news about, just how they're dealing with their credit bureau. So I think that may also be off the table too, which, really only leaves EFTA. They may focus in some of those areas. But then when you think back to just rolling back when it came to actual findings that were out there, the one for one bank that dealt with service members. So that would be interesting to see, being that they said they're focusing on service members, but they actually rolled back an enforcement action for service members. The jump fees that was taken off the table too, as well last year, which is going to be interesting. I guess if you look at,
I don't, overdraft fees, I don't think they're going to care about that.
yeah, so it's like a big of question of actually what are they actually looking at? Because I guess the biggest thing that they keep calling out is the service members, but then when you look at that, they reverse, enforcement action that was out there for, a service member, an entity that services service members. It'll be interesting to see, especially I think once those first level of request letters start to go out and you kind of start to get a little bit of information, inside information of like what are they actually looking at. But yeah, it'll be interesting to see.
Okay, well, now let's turn to the prudential regulators. Unlike the CFPB, They did continue to conduct examinations last year. They were, I think, a combination of in person and virtual. They were basically, it was business as usual, right? Did things change right off the bat in terms of their focus? That is, focusing more on risk rather than check the box kind of review.
Yeah, from my understanding, especially like at the OCC, there was no huge change in terms of, what they were actually looking at. I think the other side of that is that, they could focus and shift a little bit more on the safety and soundness side and not necessarily on the consumer protection side of it, but not just a huge change on what they were actually looking at for, their exams. I think the change that they may have had with their exams had more to do just of more of what was going on the side of the Doge part, not necessarily the actual supervision or examination part of it.
Right, right. So let's talk about where you see things evolving, because there's been a lot of one of the things that, and this sort of relates to debanking, but getting rid of reputation risk. That used to be if a banking supervisor didn't like what you're doing, but couldn't find a specific statute that you violated, they could always say reputation risk. And it was nothing you could do. You were sunk. And I had lots of experiences with that, particularly doing work for entities that were engaged in payday lending, who'd had joint ventures with banks. And when the regulators wanted to get the banks out of doing payday lending, they talked about reputation risk. That's gone, right? Out the window?
Yeah, that's definitely out the window. You continue to see where they are finally, moving to take it off. I think it was June or July where they came out and essentially said it was being removed. And then I want to say, I think something else came out this year that reach on it, but it's like you said, it's gone reputation risk. But I would say reputation risk is gone in the sense of your examiner taking a look at reputation risk, but in terms of reputation risk in what your customers look at, that is not out the door from a standpoint of reputation risk of I think you still do need to consider that as a bank. You still do need to factor that in, maybe not from an exam standpoint, but in terms of reputation risk and the thought behind what reputation was. It may have become something else, in terms of the examination process to your point of, it was kind of used to get people to sway you to go a certain way. But ultimately, when you really just step away the concept of reputation risk, that's not going to go regardless if your examiner is examining from that and it's removed from their examiner menu. There was an institution that literally got a consent order brought against them because of, a perceived thing that came from CNN. It didn't even come from an examiner that brought a whole case about it. So, I mean, reputation risk is still very alive, much so, regardless if it's in the examination book. So, I don't think a bank should shy away from ensuring that they understand what their reputation risk is when they are considering products and services and where they're going when it comes to compliance.
Mhm. What about this, large bank versus community bank impact? I get the impression that they are becoming gonna have a lighter examination touch for community banks rather than the larger banks that, they examine.
Yeah, I think in a way to streamline the process and, talk a lot about regulatory burden, that's just an attempt to kind of help banks essentially with that by streamlining the process more for community banks versus a large size bank. Because, I mean, essentially the risk in each, in a large bank versus community bank are completely different. While fundamentally, they're the same concepts here and there, but they just look different, based on the size of a bank naturally. And of course, a large bank is going to be doing a little bit more riskier profiles. Therefore, an exam is going to be a lot different at a large bank than it is at a community bank. So I think that is actually a good thing. I think the, industry has been advocating for that for quite some time. So, the fact that, the OCC is actually pushing forward with, trying to do some of that, I think is a good thing.
Yeah, yeah. So let's talk about the practical impact and what you are telling your banking clients on what they should be doing. Is there any other changes that they should be making in light of the fact that the CFPB has largely become a non-factor, and the prudential banking regulators have been told to use a lighter touch and get away from the check the box mentality and focus more on major material risks or the risk profile of the bank. And so, how are you? Well, what are you saying to your clients? Are you telling your clients when it comes to compliance, they can just ignore compliance for the next 3 years?
Definitely not telling them that for the fact that, as you know, the administration can completely change and it'd be a whole different, ball game. If, a Democrat is in office, that's just the way it goes. And so from a look back standpoint, you definitely, want to ensure that, if a look back happens, that you are prepared and that your documents and your audit trail are able to support what you did, why you did it in, this time period. So I don't think you should, move or change anything at what you're doing when it relates to the possibility that, not only can you be subject to a look back, but then also right now you could also, we kind of talk about future tense, but currently right now, I mean, you could be subject to, state AGs, you could be subject to, private litigations. And then to my point about the reputation risk, for that one, case I was talking about, that had nothing to even do with an examination or say, or, a litigation. It literally was an article that came out that, a fair lending issue for a financial institution that was in the papers a few years back. So I don't think you should change what you're doing other than if you're doing something wrong, then this isn't the time to go and do more wrong. And you should be using this time to actually strengthen your CMS and ensure that, you can be able to produce a clear audit trail, no matter if it's virtual, in person, that you're able to really and availably produce, what you did, why you did it, the decisions that were made behind that. I think, as an examiner, or, people oftentimes don't they assume that it's just like, "Aha, I got you" moment, but literally, if you can, if you with the right examiner, if you can explain what you did, why you did it, then that's the biggest piece I think that you can do in an examination is just be to document that, and I think, sometimes examiners kinda, I think, get the bad name out there that it's just a, "Aha, I got you" moment, and that's what an examiner is looking for. It's literally about having a clear audit trail and being able to explain what you did, and that's what people should be focusing on right now and not trying to reduce anything just because the CFPB is making, waves, and potentially maybe going away or still here, but just, half of what it was, a year ago. And so I think that's the key thing is just staying the course, especially if you already have a strong CMS, ensuring you maintain that strong.
And one thing we haven't talked about, but I think is extremely important, is focusing on complaint management.
Yeah.
I think supervision might become more, particularly in the consumer area, more complaint driven. And if a banking regulator has received a ton of complaints, it's hard for them to ignore that. And so that's something that banks and non-banks have to it should be business as usual. Whatever process they have in place, and hopefully it's a robust process for reviewing complaints and responding to consumers, and for consumers who were treated in an unfair way or where there might have been a violation of law, but to continue to remedy that. Do you buy that?
No, I would agree with you 100% on that, but then it does bring a question of the fact of the CFPB complaints because they have a backlog. They, have reduced staff. And so it's interesting to see, even in, like I said, the document that they had about kind of what their, or that was issued about, what their focus was going to be. I think complaints was mentioned in there, but it is, also been reported that they have a huge backlog on complaints. And so it'll be interesting to see how they'll be using that to drive the exams that they'll be conducting this year when it's more than likely probably still information given the fact that they had reduced staff. They probably they were told to not do much last year. And so it'll be interesting to see complaints those are based off of, are these still complaints or are they, complaints currently just and how that a lot of banks, have relied heavily on or presented from the CFB to manage that process. And so with that backlog, how is that gonna play into, what that looks like?
Yeah, yeah, yeah. Documentation still remains important, right? It's maybe more important. Companies have to maintain best practices regarding record retention, centralized access to documents, and exam response protocols. There shouldn't be any changes to that, as far as I'm concerned. Agreed?
I agree. What I would though point out is what I think sometimes people forget is your third party vendors that they also, should be a part of your contracts is that they're able to readily produce documentation for you when needed for an examiner. I think, from the virtual standpoint, if you have an issue with a vendor being able to readily produce information for you, that could cause a hiccup in your exam process because it's a virtual exam. They're going to be probably moving a lot faster, more of a narrow view. And so, if if your examiner in charge is asking for some documentation that you have to get through a third party vendor, and it's going to take 3 to 4 weeks for that to be produced. And if they, to get to those 70 are moving a lot quicker and faster to be able to hit that 70, we're going to be able to have that readily available, and you should be ensuring that your third party vendor management contract provides that and they're actually able to produce that because I've had instances where, like I said, the information lies with your vendor and that's a whole process to even get what you need.
Sure. What about the board of directors and senior management? Should their views be any different about their oversight role in this newer lighter touch supervisory climate?
I think from the standpoint of if you have a strong board and a strong oversight, then you shouldn't be concerned. But I do think that if there are, issues with ensuring that your board is very clear on, what their role and expectation is for them, that they should, be working on finding a way to make sure the board is very, aware of what's going on. Like I said, we had the question about the debanking part, if that's there, if you're not 100% clear on where the bank stands with the banking, I think, that should be something that the board should be, kinda a little cued into, but I think, for the most part, board oversight, if you have a strong board and senior management team, then you shouldn't be really concerned.
Yeah. Okay, Sherra, is there anything else you want to add? We're drawing toward the end of our show today. If you were a chief compliance officer today, is there anything that would be keeping you up late at night? What would you be worried about? Or are there misunderstandings that you think banks and non-banks may have about this new environment?
I say 2 things. I would say, in terms of if I was a chief compliance officer, and especially if I operated in multiple different states, I would be thinking about state AGs and just kinda where they're going. As we all know, for the prior CFPB director left, he issued that document about, creating these mini, CFPBs within the states. And so while we didn't see too much action last year, ultimately, people have to do budgets. They have to, you can't just automatically ramp up like that. And so if you just think of, that they've been spending last year ramping up and kind of getting prepared for what they're going to do over the next, year or so, that just, ensuring from a state level, while the CFPB may not be doing that much in the space of compliance by consumer protection, that your AG or AG in a jurisdiction that you're in potentially could be gearing up to do this, and that a lot of states are also preparing to do joint multi-state looks and things like that. And so, especially if you're in New York, California, I think Massachusetts is another kind of active. And if you have any business in those states, just truly understanding, what that is, what that looks like, and being sure that you're touching on it. And while for fair lending, disparate impact may be gone from the federal level, that is not left from any of the states. I haven't heard any of the states saying, at least from what I've seen, saying that they're removing that. So just because that's being removed from off of the federal does not necessarily mean that you shouldn't be keeping up with that.
And indeed, to underscore that point, the New Jersey Attorney General recently promulgated a fair lending regulation under its law against discrimination, where it absolutely rejected idea that they couldn't look at disparate impact. They specifically say in the regulation that they are going to focus on that. And I would say I interviewed the chief of consumer protection at the New York AG's office. We released a podcast show a couple of weeks ago. They have a new law in New York that gives them they previously only had the authority to companies engaged in deception. They've now added the unfairness prong and the abusive prong. And believe me, they're hiring people and they are full steam ahead. They are clearly doing their job. And you got to worry about some cities too, like New York City. The Department of Consumer and Worker Protection that is being managed now by Sam Levine, who formerly was the head of consumer protection at the Federal Trade Commission. And he means business. He's looking into going after companies that are charging junk fees. He's looking into subscription practices. If you make it hard to terminate a subscription, they will go after you. There's no question. So, and California, they haven't, they're clearly as aggressive as they've ever been. And a lot of what's happening with a lot of alumni, both the CFPB and state AG offices to some extent, they're opening up private practices to focus on consumer protection law. And a good example of that is Matthew Placken, the former New Jersey Attorney General, who hung out his shingle about 2 or 3 weeks ago. We opened up a new law practice with several of his colleagues from the New Jersey AG, and they're going to focus entirely on consumer protection and things that they don't like that the government is engaged in, meaning mostly the federal government. So let me, first of all, thank you very much for taking the time to join us today and to share your thoughts based on the experience that you've had. So thank you, Sherra.
Thank you, Ellen, for having me. It was a good discussion.
And for our listeners, here are my 5 quick takeaways, okay? Number 1, don't confuse fewer exams or virtual exams with less risk. I think that is probably the most important thing. Number 2, complaint management and data analytics will become even more important. Documentation discipline matters more in a virtual environment. Compliance management systems should not be weakened simply because oversight appears to be scaled back. And finally, leadership oversight and tone from the very top, meaning the board of directors and senior management, still remains very critical. So thanks again, Sherra, and our thanks to all of our listeners who took the time to download the podcast that we have released today.
And we look forward to your joining us every Thursday. This is a weekly show, and I hope everybody enjoys the remainder of their day. Thank you.